Okay, so good afternoon, everybody. We will start again. And I will start with a big thank to Ben Caldecott and his team for putting together this partnership and organizing this event in such a great venue. Thanks also for inviting me to moderate these 4 sessions. It's always a pleasure to bring a French touch and accent in such a great British institution. So the first 3 panels gave us an overview of progress in sustainable finance across the world, and especially in Europe. They stressed notably the great potential of fintech to address the challenges, the role of private sector initiatives, as well as the need for reforming financial regulation. So our session will focus more specifically on this last topic. We will discuss how sustainability objectives are currently being integrated into financial regulation and other policies that impact the finance sector. We will notably discuss the upcoming European Commission Action Plan on Sustainable Finance that builds on the recommendation of the high-level expert group, and we will have one of the members on the panel. Then, just after this panel, the last panel moderated by Ben will more specifically focus on how financial regulators can help manage climate-related risks. I'm Stan Dupré, CEO of the 2-Degree Investing Initiative, a think tank that I created a few years ago to support the integration of climate goals into financial regulation. So when we published our first report, it was in 2012, called Connecting the Dots Between Climate Goals, Investment Processes, and Financial Regulation. To my knowledge, the topic was not really on anybody's agenda. And to my knowledge, the only organization really vocal on such an idea was the activist NGO Banktrack, who was notably advocating for the integration of climate criteria into Basel III. This idea, and more broadly the concept of leveraging financial regulation to advance sustainability objectives, were almost systematically categorized as irrelevant and not realistic by most of the financial regulators we were talking to at this time. The financial crisis was still in everybody's mind, and the only focus was on strengthening the resilience of the finance sector to the next shock, build a kind of cushion, but ensuring that this financial regulation also supports long-term policy goals, including climate goals, wasn't really on the agenda. I remember a conference like this one, organized by Finance Watch in Brussels about 5 years ago. And a representative of an NGO asked to one of the top financial regulators in Europe about his thoughts regarding the link between climate and Basel III. His answer was very short and very simple. I don't see any connection between those 2 topics. A couple of weeks ago, I attended a roundtable where I heard the same person passionately promoting a change in capital requirements calculation in order to support the transition to a low-carbon economy. So we've come a long way, a very long way, in only 5 years. So that's good news. A few months after my think tank started its activity in 2012, the French Ministry of the Environment and the French Treasury published a first joint report on sustainable finance. This collaboration was the first of this kind, I think, in the world. And with the involvement of the Parliament, it eventually led to the introduction of the Article 173, the first law on mandatory climate disclosure for investors, that also required target setting from them, and also introduced the concept of climate stress test for banks. A few months after that, I was invited at the Frankfurt School UNEP Finance Center for the launch of the UNEP Inquiry, an international initiative that put the question of sustainable finance on the agenda of financial regulators in many countries, as well as on the table of the G20. One of its first successes was to facilitate the creation of an expert group on sustainable finance that advised the Chinese government and the Chinese central bank on the development of their sustainable finance action plan. I took part to this group together with one of our panelists, Alex, and Ben. It was very impressive to see how the Chinese regulators were open to use financial regulations for promoting environmental objectives when this topic was still taboo in Europe. A second big milestone on our journey was the speech of Mark Carney, Breaking the Tragedy of the Horizon. This speech kicked off the TCFD and the debate on climate disclosures, especially for investors. And besides, the speech also put emphasis on the role of financial regulators in monitoring climate risk, a topic that will be discussed in the next panel. This topic is now on the agenda of many central banks who will meet in April to explore how they can conduct climate scenario analysis and stress testing. Finally, the latest and probably the most ambitious development in this field is the Sustainable Finance Action Plan of the European Commission that will be released in a couple of days. Like one of the panelists, I was a member of the high-level expert group who developed the recommendation. I think we were all very impressed by the openness of the Commission to new ideas and how the mindset of financial regulators has shifted in a few years. So we have come a long way in a short period of time. There's no doubt about that. Now the multi-trillion question are, do we go fast enough? Are we on the right path? And what are the necessary next steps on this journey? To explore these questions, I will invite 4 panelists to join me on stage. First, Silvia Kreibiehl, who is co-head of the Center for Climate and Sustainable Energy Finance, a collaboration between the Frankfurt School of Finance and Management and the UNEP. The second panelist I will invite on stage is Michael Schmidt, Managing Director of Deka Investment in Germany, who was also a member of the HLEG. Third, I will invite Nick Mabey, who is CEO of E3G, a non-for-profit based in London that was also represented at the HLEG. And finally, Alexander Barkawi, Director of the Council on Economic Policies based in Switzerland, who was notably the expert on monetary policies for the UNEP inquiry. So thanks for joining me. Yep. I will stay here. My first question to you, and I will suggest Michael to kick off the debate, is your general perception about this momentum on sustainable financial regulation. So what are the main drivers? Is that G20, Europe, China? I don't know. What is missing and what is next?
Well, thanks very much, Stan, for the question, and also thanks for having me here in this great building. And I think a lot is happening. It's not only one single initiative or one single project. And when I look at what's happened in Germany, for example, which I'm close to in terms of also the regulatory environment, the last 12, 15 months have been quite instrumental in moving things forward in areas and at institutions where you would not have thought about it, or where it wasn't a subject 2 years ago. I'm talking the Treasury, I'm talking the Bundesbank, I'm talking the BaFin, to the supervisor. And I think a catalyst was indeed the TCFD work, also the chairmanship of Germany for the G20 Green Finance G20 group and the G20 Green Finance Study Group in particular. Also, the Bundesbank has had proponents on the board that saw what was happening here with the Mark Carney speech and were considering that there are actually potentially systemic risks stemming from climate change. So that was all instrumental. And of course, I think the biggest driver of late, and forgive me for saying that even if I'm sort of attached and an interested party, but the high-level expert group on sustainable finance as an initiative by the EU Commission, so the legislator of the European, the government of the European Union, that is a serious driver, I think, and therefore it'll be interesting to see now what's being put forward as an action plan. What we hear is that the EU Commission is keen to take on a lot of the recommendations we proposed at the end of January. But this is also necessary because some of the legislation that went already in that direction in Europe, with some of the directives like the NFRD directives, the Child Rights Directive, the IORP directive, they need to be connected a bit better. And I think that was realized by the EU Commission when they tasked the group, the high-level expert group, to come forward with a full set of recommendations looking at the whole system, in fact, and not just single points. So there's a great dynamic, and I think it's been more dynamic than I've ever seen. Now it's really about implementation, and I think that's going to be a bit of the hard bit. But if everyone comes in from everybody's perspective in terms of institutions, regulators, policymakers, then I think we are on a good path and can actually get it the way we ought to have it.
Thank you, Michael. Maybe I will now ask Nick to give his perspective on that. So you have been working for a long time on this question of energy policies and like sustainability for the UK government, I think, at some point. What is your view on that and on the evolution and the potential next steps?
Well, thanks for inviting me, especially as even though obviously E3G and especially Ingrid Holmes, who is on the H leg, kind of works on finance, my personal portfolio covers a much broader space. So I suppose my reflection is comparing finance, sustainable finance to other areas, I would say it turned up late, but it's moving fast. And I compare it to, we did a lot of work on climate change and security, so interesting non-green area. The first UN Security Council debate on climate risk and security was in 2007, when the financial community was a long way away from considering these issues, but we had generals and foreign ministries and intelligence chiefs talking about climate change and risk. But they failed to follow up, actually. The process there, they produced an awful lot of risk analysis and coloured maps and interesting indices, and you'll be aware of all these things. But in terms of turning into a different way of doing business, it's been really disappointing. And I think the most interesting thing about something on sustainable finance is, yes, in a way, in terms of the mainstream policymakers, kind of getting this was something they had to address to deliver their objectives. It was late, but actually I'm quite encouraged that in a way you may kind of not have that failure to go between the risk assessment and the actual delivery. And I think that's where the next few years are really important, and particularly the delivery on the H-leg and the Chinese Green Finance Plan and the TCFD are so important. And that does raise a few risks because there's a big change. There's a big difference between coming up with great ideas like, the carbon bubble, I wouldn't say carbon tracker in the front. I mean, these ideas have been around for a long time. We first talked to carbon tracker before Copenhagen. Just to be clear, the history of the ideas has been around a long time. Moving from putting ideas on the table to delivering them through legislative systems with incumbent interests and national processes and is very different. It's a very different way of working. So the first thing I'd say, I think that if we want to keep the momentum up, is we need to get organized in a different way around policy processes, delivery, even things like data, whether that's non-governmental or government, particularly talking about policy here, making sure we get the right answers is a very different task to putting some propositions on the table, because you get a much stronger level of detail and you have to act in a more political way, because these are political choices, even if they don't look like political choices. The first one, organize differently. The second one, realize the world will be bumpy out there. The world, we're in the middle of an incipient trade war. Cooperation on regulation and international rules are not the flavor of the month at the moment out there in terms of the broader politics. And it's quite important that this community not just kind of risk manages down into its world and mainstreams inside finance, but also tells its story to political decision makers where it needs their help. So a lot of the answers for finance lie outside finance regulations. So again, what's the finance sector going to say to the energy sector, or particularly, we can talk about 2050 planning, which is one of the key things you have to play off, long-term energy and infrastructure planning. You have to have a voice into the policy debate, not just into your own sector, to keep the momentum going. Otherwise, you'll fail to push some key barriers. And the last one, which I think is an amazing opportunity, is a public narrative. And this is a great narrative, H-leg or elsewhere. This is about changing the finance sector, which most people in the world see as opaque and inflicting damage on them, especially in Europe, to say, no, we're reforming this to be good for you, to finance for everybody, for the long term, on the things you care about. And I think, again, to maintain momentum through the bumpiness, through the difficult politics, through the policy process, you have to explain why the public cares and bring the public along with you. And I think that's a really exciting part of this, which would change the way finance is seen by the public and would give a really firm political basis for moving to the next stage.
Thank you, Nick. I will now ask Silvia, like the same question, basically, what's your take on this, on the dynamic, and where you see the drivers and next steps?
Yes, thank you. I want to keep that rather short, given that I have presented some of my views already in the opening remarks this morning. I'm a bit undecided, as you are. I share this enthusiasm that we have convinced many regulators and also people in the ministries to actually listen to our ideas and concerns, and that they share now that there is a need for action. I think that's a really good development. I think in terms of awareness raising, we have made significant progress. On the other hand, I'm a little bit concerned that there is currently a too strong focus on financial sector regulation, as you mentioned it before. And as part of the UNEP family, I've experienced exactly that. Yeah, we lobbied for the carbon price without success, then the green economy concept, and then finally the UNEP inquiry. And the most successful concept was the UNEP inquiry into financial regulation. And I also really have significant concerns that the H-leg recommendation and the momentum we have generated in the financial sector reduces this perceived need for real economy regulation. And I know that you have stressed this aspect in the H-leg report. But my feeling in the current discussion is that many politicians now believe that the finance sector will fix the problem. And that's really one of the key concerns. My second concern relates to the strong focus on materiality, because it's a very narrow focus. And actually this is completely different in many emerging economies and developing economies compared to, for example, the discussion we have here in Northern Europe, where the focus is solely on financial stability. In many emerging and developing economies, it's very clear that finance regulation also has a secondary pillar on social inclusion, or maybe on climate finance. And this has never been an argument here in Europe. So we focused on materiality. Now, my concern is that if we focus on the risk, we want to exclude more or less the brown stuff. We sometimes think about encouraging more green investment. What's happening in this middle part? And are the suggestions for regulatory interventions actually supporting this transformation? Because if we want to create demand for green products or for sustainable finance, I think the interventions would look different compared to the question whether I want to ensure financial stability. So a little bit undecided.
Thank you, Silvia. So, Alex, I think you want to ask even more from like financial supervisors and regulators. So, can you
yes, indeed.
tell us a little bit?
And I'll start with your question, Stan. So,
yeah.
Are we on the right track? I think yes. Are we moving fast enough? Definitely no. And what comes next, I don't know. But I'd like to share one example of where I think we should go. And before I do so, share another thought following the conversation we had earlier and just here on regulation. I think we really can't talk about regulation as an abstract. The discussions we need to have are concrete proposals for concrete regulation, and then we can say that makes sense, or that should be market-driven, or we need policymakers to intervene. Obviously, we need regulation and we need a policy framework for any sector to function, and I think financial markets are no different. The concrete example that I want to bring is the example of central banks, which in a fascinating way are somewhat absent from the conversations that we're having. They've been rarely mentioned here today. And I find that fascinating because, especially over the last few years, they have intervened in a very significant way into financial markets. If you look at the balance sheets of the largest central banks, they've just crossed $20 trillion. And we're having conversations around what pension funds do, what insurance companies do, what foundations do, and we have no conversation whatsoever what the balance sheets of central banks look like and to what extent the issues that we care about should be reflected in that. And to put that into context, the numbers that we're talking about, the European Investment Bank has recently come up with the amount that they've invested into climate finance over the last 5 years. And that amount was, I think, 90 billion euro. The European Central Bank is currently injecting 30 billion euros into financial markets on a monthly basis. So, and that's already the lower amount since January because it was 60 billion until January and 80 billion before that. And I'm not implying that all of those 30 billions should be shifted into green bonds, etc. That's obviously not possible, but I think we should have a conversation to what extent climate risk analysis should feature in those monetary policy tools. What is encouraging is that central banks over the last few years have entered the debate. They have engaged with commercial banks. And now, coming back to your third question, my hope is that they start doing what they ask commercial banks to do in their own policy toolkit. Because central banks are engaging with commercial banks telling them there's a mispricing of climate risk in financial markets, and therefore we would like you guys to ensure to us that you're taking these climate risks into account. And I think it's very odd if they didn't do that themselves in their own criteria for eligibility of assets that they purchase and for eligibility of the collateral that they accept in refinancing operations with the commercial banks. And again, to give you concrete examples of what is currently happening, the European Central Bank since November 2014 has been buying asset-backed securities based on car loans. Now, I at least would like to have a conversation whether that is needed, whether it's in line with the mandate, and what alternatives the ECB would have had. The ECB, similar to the Bank of England, has a significant corporate bond portfolio that is heavily skewed towards high carbon assets. I understand why that is the case, because high carbon assets are those that have higher volumes in debt outstanding, but nonetheless, there is a bias in those investments, and I think we should have a conversation about that.
Thanks, Alex. We will have time for Q&A, and I see a couple of central bankers in the room, so we might have a debate on that. For my second round of questions, I would like to focus specifically on Europe and this upcoming action plan. So I think the action plan leaked a little bit, so you might have some views already on the content of the action plan. It will officially be released on Thursday. And so I will start with you, Michael, as a member of the group. So in your views, what are the most important action in this, in the H-leg report, not the action plan yet, and how big of a change for Europe?
Well, big questions, right? But it is, when you look at the final report of the H-leg, then you find 28 recommendations connected by 4 themes. And I won't elaborate on each of the 28 recommendations, don't worry. I'd rather cluster them in 3 areas, which I think are key, and you can sort of connect, if you want to, some of the recommendations to those areas. The first area is definitions and standards. And so there you've got taxonomy, you've got definitions and standards, meaning also standards for green bonds, anything that gives, I'd say, orientation, because that's something that is lacking in sort of mainstreaming the sustainability in the financial sector, especially towards the retail market. The second area is clearly of action is culture and behavior. The H-leg and the European Commission really wants to change the system in the sense that sustainable finance becomes embedded such that it serves a sustainable economic development. And therefore its culture and behavior And that's triggered through, for example, the investor duty recommendations, the governance and leadership recommendations, also the recommendations on the European supervisory authorities. Because if sustainability becomes enshrined in the supervisory dialogue, I can assure you that my colleagues who may not be as attached to sustainability as I am will have to listen, and they will listen. And so that is important. Also qualifications on this note, and education and training certainly. And the third area of action is transparency and impact, and measuring the impact of what is happening. So transparency, of course, goes down then to disclosures, proper disclosures, TCFD-related disclosures, scenario analysis, and also we propose this EU observatory on sustainable finance, which I think is crucial in order to measure success going forward. But then also it is highlighted that it needs to be interconnected with, as Silvia Kreibiehl already mentioned, with the policy making in the wider economy. I hate to say the real economy as a term, I don't like it in particular, so I say the wider economy, because that it needs to be consistent. So these are the action areas, and what is to be expected, I think, from, not because we've seen the document in detail, but what Vice President Dombrovskis has said publicly on several occasions. It'll be around taxonomy, it'll be around standards and also labels from an EU perspective. It'll be around investor duties. It'll certainly be also around, related to it, governance, and also on this disclosure. And so we will see what's coming out, but we are quite thrilled that, in fact, the EU Commission builds on a lot of our recommendations and takes them up and actually puts them into concrete actions with, I'm sure, also some clear milestones and targets in terms of the timing. This commission is running out of time, if you will, because next year there's going to be a new commission. So they are eager to actually move forward fairly fast.
Thanks, Michael. Silvia, you were mentioning that we might expect too much from financial regulator, and they won't save the party where environmental regulator fail. How do you see the H-leg report and the action plan in this respect? Do you think it's asking too much from?
Actually, I think it's good to see this aggressive timeline. Yeah, I would have loved to see such an ambitious plan for fixing the ETF. And I think it's a really good first step. What's important is that it's very, very quickly complemented by a coherent real economy regulation and a vision for a sustainable Europe, or a very ambitious European emission reduction target. And I believe that this was massively help also to increase the risk perceived or seen by the financial institutions. Yeah, now we have the financial regulatory framework then in place, and certainly, and if they have to do their risk analysis, would certainly help to create a vision how the real economy regulation would look like, how concrete scenarios would look like for the assets, and then to apply the financial regulation. I think the introduction of the financial regulation will definitely raise some awareness, and that's always a good first step. And for me, the key question is what will happen in the next 10, 20, 30 years in the financial sector, and we had a little bit of discussion this morning on that topic. So how will asset managers work in future? Will there be service providers actually adding climate data and climate risk assessment to the financial analysis? Or will it simply become a core business that asset managers have to understand the adaptive capacities of companies? And I think it's core management, management tasks to adjust to changing and to external factors. So climate change is for me just one of those external factors. And many of the private sector players, we know they hate this term adaptation, because for them it's simply normal management of their company. So will it become core analysis? And if so, what would be analyzed? Is it just another mega trend? I mean, a research analyst also considers other mega trends like digitalization or automation. So is it just like that they also have to learn more about climate change and how this will affect the business models, or we will continue to focus on emission data or some other key metrics? And I think this is something which need to be considered for the next phase. How can we raise the awareness to a level that financial intermediaries feel comfortable with this risk and feel comfortable assessing this risk?
Thanks, Silvia. I will now ask to Alex. There's a lot of emphasis on this green taxonomy. You told me yesterday that you love this idea. So can you develop a little bit on that? And the other aspect is, since the ECB is independent, the kind of the recommendation to the ECB were out of scope. So can you share your views on on those two aspects?
Yeah, I love your cynicism. Because personally, I think the taxonomy proposal as it is worded and framed in the HLAC report takes us on a very dangerous slope. I fully understand that a taxonomy is needed if government in general or the Commission in particular wants to come up with regulatory measures, and they need a definition of what they want to regulate. But what I find extremely dangerous is, at least that's how I read it at the moment, that a taxonomy is developed by a multi-stakeholder group that is then seen as the starting point for everything else that is happening in that market, and product development and index development and rating development. And I think that just neglects the fact that actually institutions like Deka for the last 10, 20 years have been in this market providing products and services. Sabine has been in this market for a very long time, and many of you as well. And I just fear that having a multi-stakeholder group defining what it is will completely slow down the dynamism and the innovation. I'm not saying that we don't need this for regulatory purposes, but I think that's where its scope and impact should end. Now, on central banking, indeed, I was disappointed that there was no mention in the HLAC report of the role of central banks. I understand that that probably has to do with the independence of the ECB. But at least I think it would have been worth a footnote to say, hey, there's another big kid on the block. This was not within scope, but we shouldn't forget it. And maybe as a last point, since you mentioned independence, the ECB mandate actually has two sentences. The first sentence is, the primary objective of the ECB is price stability. That's usually where ECB representatives end the quote. The second sentence, however, continues saying, without prejudice to the objective of price stability, the European system of central banks shall support all the economic policies of the Union with a view to supporting the goals of the Union as listed in Article 3. And Article 3 includes a high-quality environment. So I think as long as the ECB, and it's similar for other central banks, don't endanger their price stability goal, they are allowed, and I would say arguably required, to look at these issues.
Thanks. Nick, so through the involvement of Ingrid, IFRIG has been involved as well in the development of the report. Are you more enthusiastic about this taxonomy, and what are your key takeaways from the adventure?
I'll get to the taxonomy. But I think on the HLAG, again, this is a process, not a point. It's the beginning of a process. I think my hope would be this isn't just put in another tick box political trend exercise. I also do political risk analysis, a lot of that. And I see how financial markets treat that. I don't think that's how I want them to treat climate risk. I don't think it's material, the way they do that on most analysis I see. So I would like to see this beginning of the acceptance of the financial system that they have a purpose. The purpose is to support where our society is going. Our European society and global society has made some decisions about where it's going. And that's important because, for example, in the debate we're about to have about Europe's targets over the next 5 years, we will decide most of Europe's 2040 target on climate change. That's pretty seriously affect the whole of the economy. And the majority voices from the theoretical economists who say flexibility is the most important thing you can have. Whereas for investors, certainty is very important too. There's a trade-off, but at the moment in the debate, there's no trade-off because there's only one voice. So finance can't sit on the fence and say, well, we'll work out how to optimize a 4-degree world. There is no optimum in a 4-degree world. It's a catastrophe for your portfolios. So you have to decide you're not going to go there. That requires you to go somewhere else. And I think that's the big change. You can't just sit on the fence and say you're playing and risk hedging. The world either is sustainable or not, though you can argue about some of the degrees. But the capital holders have to be in that debate. At the moment, you're abdicating from it. And that is actually skewing the societal debate because other forces are overcome. So that's where I'd like to see, and it's a political reflection of H-leg. In terms of some of the pieces coming out, I think the observatory, in whatever forms it comes out, is incredibly important. We don't know where the money's going, who it's going to, how it's flowing well enough to know if we're succeeding and how to change over time. And we've got to trust those numbers and that observatory. So it's really important that we do that and we trust the number. The taxonomy, I have very mixed feelings about. I've been involved in this field for a long time, gone through a lot of environmental labeling, creating of global markets in labels for things. It is an art form of itself. There are a lot of pitfalls, and we work a lot in the grey area of should you invest in this urbanization project, this gas grid. The things aren't easy green or brown, and they require a lot of analysis to understand for which country at what point something is financially or environmentally sustainable. So I think we have to approach it with care and not lock in bad things that kill innovation or just give the wrong signals. And again, that's why that discussion has to relate to the issue about Europe's 2050 plan and member states' 2030 and 2050 plans, which are in the governance regulations or not, because you need those plans to do that taxonomy. If there aren't a plan in the energy and infrastructure space, how can you come up with that for the difficult things like real estate, which are big parts of portfolios? So again, I think that's an area where the logic of the H-leg means you've got to go to the next stage. And the last piece we really want to see is the sustainable infrastructure facility and its the different elements there. We need to get money where it's needed. It's not going where it's needed at the moment. That positive agenda is incredibly powerful. New tools to buy better flows to more people, particularly in east and south of Europe, to bridge that clean investment gap and create jobs. And that's one of the key challenges. And my last note, kind of back up, I agree everything you said about central banks. They haven't got climate risk on the balance sheet. It's not a contingent liability for treasuries. It doesn't exist. And the kind of part of the phase beyond where we are now is really gripping climate risk in Europe. We're not adapting, we're maladapting, we're building up liabilities and we're not measuring it. And that is one of the reasons why our debate isn't where we need it to be. And again, I think the finance community has a really critical role to play there to say, show me you've managed this. If you can't show me you've managed it, you're going to pay more for your money. Because at the moment, no one's getting that signal. And they all know it as well. This isn't the thing that people don't know this risk is out there. They're just kind of hiding it.
Thanks. I would now want to focus, and maybe Nick, you can start on that since you're local. Like on the UK, because there have been a lot of Brits in the H-leg actually, but they might not benefit from the action plan at the end of the day. So what are the implications for the city and for the UK of this trend, and how do you see the connection between the dynamic on continental Europe and the debate here in the UK? And the other, feel free to also answer.
Yeah, the dreaded Brexit question. I think it's been very interesting, and we do a vast amount of too much thinking about how Brexit might evolve, which just ends up with having a confused brain. But I think what we've seen, interestingly, is that the dynamic has mainly actually been competitive to date, particularly between Paris and London. And funnily enough, that's been really positive, particularly in London, but I think also in France. We probably need to move to a more cooperative space at the moment. So this idea that everybody's going to be a green finance centre reminds me everybody's going to be a biotech centre. Everybody's probably going to be an AI centre. It's a little bit, that's fashion. It's fine. Fashion can drive things. I think now people are being a little bit more realistic. There's probably a lot of green finance to go around. Green finance is finance, so it's not something completely new, though there are opportunities. I think it's really good that Sweden has emerged as a front runner for standard setting and getting things done. It's put pressure on some of the perhaps slightly lazier incumbents to move harder. So I think the UK has started to build a pretty impressive portfolio of interventions on green finance. It wants to stay financing the European economy. I'm not sure that's going to be that easy in the first stages after Brexit, given the different scenarios we're going to. But I think the key thing we don't want is a fracturing into wars of standards and somehow using standards as competitive. That would be a disaster for everything. So that's why whatever's happening up here in the macro political level, way above all of our pay grades, building the cooperative sinews between the financial centres, and particularly around some of these key issues of how we set standards, what we think of green, how we work internationally to change other countries like China, see that as a cooperative activity, not a competitive activity, is really important. Otherwise, we could get caught in the turbulence, shall we say, of other issues when we just need to be getting on with investing.
Okay. Maybe Alex, you can also, so maybe Zurich will be the next the winner from that and the next green financial center. What is the kind of, how this edge-leg dynamic and like the dynamic of the European Commission perceived in Switzerland? And do you think it's like kind of creating a momentum?
I think it adds. I would first like to say something on the UK though. Just with a focus on the small area that I've been working on monetary policy. I mean, the Bank of England has really been the pioneer in this field. Mark Carney has been mentioned, and others on the staff and the decision-making groups. And that over the last few years was instrumental in moving that topic up the agenda. And my hope would just be that now the Bank of England is also taking leadership in actually integrating these insights into its policy toolkit. On Switzerland, Sabine is in a much better position than I am to judge where the government stands. The Swiss National Bank is one of the few central banks that is investing into equities in the first place, and one of the few central banks that has defined exclusion criteria, actually, as they invest into equities. These exclusion criteria, I would say, are very limited. So my hope there would be that the SNB moves one step ahead, that we've signed up to the Paris Agreement, for example. Let's make sure our criteria for the equity investments are aligned with our policy commitments.
Okay. Other views on the UK and dynamic created in other jurisdictions by the Commission?
Well, I'd say the climate, our world climate, does not care about Brexit, nor does it care about remarks by Mr. Trump. It doesn't stop at borders. So I can only advocate that we as Europeans, continental Europeans, just keep the door open, and actually we should be aligned on something that is a global issue, not an island issue, not a continent issue, not a European issue. It's a global issue. That's all I can say. I'm not sure whether Brexit accelerates or decelerates efforts around sustainable finance, but that would be my approach to it. Keep the door open and then actually cooperate. On Switzerland, I might want to add that I was invited once to, after this interim report, I was invited to speak in Zurich, and it was amazing to see that it seems that a lot of the players in Switzerland sort of were waiting and longing, one could even say, for the final report and the EU action plan coming out so that they would have something to chew over and also have maybe some orientation. And I was amazed to see that this interest. So I guess it is really about implementation now, and we should not sort of get the implementation track, make it too difficult just because we have different views around maybe between France and Germany on nuclear versus coal and so on. I think these are not the debates that bring us forward. It's every country has their own peculiarities and they should be taken into account. But overall, the goal, I think, is the same for us, and we should work towards that together.
Thanks, Michael. I think we will now have time for a few questions from the room. So, yes, I see one hand in the back from familiar face. So when you ask a question, if you can please say your stand, say your name and organization.
Jacob Tomei, 2 Degrees Investing Initiative. If you could suspend belief and implement one of the H-leg recommendations or the leaked European Commission Sustainable Finance Plan recommendations, what would be the one and only recommendation that you would implement, assuming that could be the only one and assuming that politically and technically it's all possible? The question to all the panelists.
So who wants to take this one?
I can take that. There is one which is kind of mentioned as an aside in there, where it says that commercial banks should integrate climate risk analysis into their own risk models. And then it goes on and says, and if that means that higher capital adequacy ratios are required, then that should be explored further. And I think that's the one that I would focus on. So just to open that up a little bit, I think the other proposal on capital adequacy that was not put forward, but put forward by the Commission, the green supporting factor, I don't agree with that proposal at all. But I think increasing capital requirements for loans or assets in general that have high climate risk, that makes sense.
There can be only one. Another view on that?
Well, the spirit of the report, I have to say, is not built on modular recommendations. It is interconnected recommendations. So I can't give you the one recommendation, really. What I would say, though, is the goal, and what Alexander mentioned is also leading towards that goal. The goal is that in every day's decision-making, at the desk of every portfolio manager, of every lending decision, sustainability is taken into account. So this is and then we succeed, because this is mainstreaming, this is bringing those considerations into the core, and it would then automatically also result into different risk assessments. And of course then cost of capital would adjust, and so it is that to my mind is most important. And I can't and I won't give you the one single recommendation, because that's not the spirit of the report, and I don't want to make it look as though there's the one silver bullet.
Yeah, I must admit, yeah, it's like when my children say, which one of us do you love most, Daddy? Some questions you don't answer, or you're accused of cherry picking, which is the other big sin of the moment. But I think there's this issue, I mean, the other side of the coin of the risk analysis one is, let's be real, we haven't created at scale green finance markets, and actually creating the money and incentivizing the money to flow to places, particularly again on energy efficiency in countries which are way away from the European average on the housing stock. And this is over half of the investment load. So it's just not there. It's a missing market, and it needs a lot of new infrastructure funding and approaches to build those markets, because they come in city level, town level, etc. So, if you're saying, what people talk about a lot about risk here, but on the other side, I think we'll make sure we get enough pressure on that market-making process, which needs a lot of public money and deep regulation to make it happen, but it's financially sustainable and economically sustainable and beneficial at the same time. So, I want to make sure that those are the cluster there, carry on forward, and not just the clever risk metrics, much as I love clever risk metrics. This is part of my background.
I think for me it would be extremely important to include and consider also those recommendations and interventions which would help to accelerate the transformation and accelerate the demand for sustainable products, sustainable financial products. I think that's extremely important. What can help to change the demand patterns and then ultimately to make the financial regulation also superfluous. I think that is very important. I know that it's not the center of the recommendation as we focus on materiality and climate risk. But I think in the mid to long term, it will be extremely important that we change demand patterns.
Thanks. Yes, Mr. Please.
Yeah, hi, Chris Dodwell from Ricardo Energy and Environment. So I'm really taken by some of the comments that the panel have made about implementation and how we need to get the ball rolling. And one of the thoughts I've had just during today is that quite a lot of this feels like it's quite complicated. All of the data points, the sort of the blockchain analysis, the infrastructure that you need to put in place. we've a bit of practice of doing this in the UK. Green Investment Bank, that was set up in the UK, had 5 green criteria that it had to assess. And actually, the way that they did that was set up a pretty simple model that allowed them to assess every prospective investment against those criteria and to look at some quantification of it. And actually, you know, as a consultancy, we provided them with the model. Didn't cost an enormous amount of money. Wish we'd charged them more for it, but there you go. Did the job. And to what extent are there things that will do the job to get things moving more quickly and that strike the balance? Because I think I was just struck by what Michael was saying about the important thing is that people start to have every investment decision being taken against green criteria. But that doesn't mean you need to have perfect information. So how do we strike the balance in terms of the acceleration that, Silvia was just talking about? How do we strike the balance and get things moving, but we don't let the best be the enemy for the good? And I'm not so close to the H-leg process, so I don't know how that balance was struck there, but is that what the Commission's real challenge is around the plan for action?
Michael, you want to take this one?
Well, I think if we were to prioritize certain recommendations and make them a forced sequence, I think we would go down the wrong way. I think there are some priority recommendations. We called them that way even, but that's more, well, these are those that will make the biggest change, we think. But I would also agree that it should not hinge on certain preconditions. So you can already start changing the culture, having the supervisory dialogue without having the taxonomy. The taxonomy should give orientation, and it's meant to come quickly in terms of the first steps of climate mitigation. And so I would always advocate that we should not wait for someone else to arrive or happen or someone else to move first, but rather take those concurrently as we can. Of course, there are some interdependencies, but I think the cultural bit we can start now. The clarification of investor duties, we don't have to wait for the delegated acts or for the for whatever is needed in terms of legislation. I think now the debate has already started that actually investor duties do not constitute an opposite to or a contradiction or a hurdle to implement ESG issues, and I think that's important. So I would think we should just move ahead with the recommendations or fulfilling all the steps we can at the same time, and not try and be too clever about them.
Nick?
Yeah, I sympathise with this one a lot. I'm being very practical, and I think that's why I slightly worry the taxonomy is seen as the kind of top of the mountain, everything trickling down. But there is a trade-off between accuracy and maintaining particularly a brand. So the first thing the GIB did was invest in a coal power station and switching to biomass, which is probably its most controversial investment over its whole lifetime, and it dogged it all the way through to privatization, and we advised against it. We said, this is a minefield, biodiversity, but biomass sustainability is a complete minefield. The Forest Stewardship Council has a 3-chamber parliament to set global standards for standard setters around sustainable forestry, because that was the simplest form of getting that sustainability criteria. So if you want to have a brand, an eco-label or something, you need to have and it's statutory or has some kind of long-lived thing, you need to have a very accurate, legitimate process to get it. If you want to make better decisions, you can do things a lot lighter, but don't call it an eco-label or a standard. So again, this is why I worry, I think we need to think very practically about this and not mix up those two things. There is no one definition. There are some things that are easier to define than others. Talk to the WTO about green goods and services. We've been here before, and we shouldn't repeat the mistakes of the past. We know a lot about how to create markets in green products. I'm not sure all of that practical knowledge has been ported into the Commission staff doing the action plan. I think that's one of the places we could really learn some lessons from ourselves to do this right and get that balance in the right place. And I'm not saying it's easy. This is tricky stuff.
Thanks. So we have 7 minutes between us and the tea break. So I will take one last short question, and then I will ask the panelists to give their final word on on the topic as a food for thought for the tea break. Please.
Do you think there would be any risk of creating an uneven marketplace between Europe and other regulated regions by pushing this agenda? Or has it been considered in the thinking, in the thought process?
I mean, I think the risk is definitely there, and at the same time, what you're alluding to is probably also something that is holding people back, where they say, if we now move in that direction, let's, for example, say we increase capital requirements on loans with a higher carbon intensity, right? Then people might say, well, if we do that here and US banks don't fall under that rule, we have an issue. So, I mean, I think definitely that risk is on the agenda. There are at the same time the opportunities. But generally, I feel this has become a pretty global conversation. If I look at the world of central banks and financial supervisors, they have just come together last December to form a network on the topic that includes the Monetary Authority of Singapore, that includes the Central Bank of Mexico. So I think that wouldn't be my prime concern.
I just think, I think I struggle to find it being material. A lot of these things people come up with theory. But let's just think about what we're doing here. We're trying to avoid making bad investments. That's good for the European economy. We're trying to make sure the investments Europe wants to make, as decided are good for it, as cheap and as liquid as possible. So that's good for our economy. So both of those are pro-competitive. The only place I can see which you could have a short-term issue is, should the city list Saudi Aramco? There's a financial stability issue about what's the cost and benefits of having more fossil assets on your system. And of course, Saudi Aramco has a slightly different risk profile than, very expensive offshore Brazilian oil. So, but I think that, again, that's in the margin of one player, of one very small type of piece. The majority of it, this is just good economic management. That's all it is.
Thanks. So I will just ask one final word to each panelist, and then we will join the tea break.
Well, for me, as someone who's worked in the financial industry for, nearly 25 years, this is a very defining moment I think we are living in, and I'm very much attached to the sustainability issues, have been for quite some time. But I see now a real opportunity that we, as a financial industry, can actually reinstill some purpose and sense in what we do every day, and thereby regain trust that was dramatically lost in the wake of the financial crisis. So for me, this is not only about, and it is of course about financing the climate change and so on, but it is also about a cultural issue and something that I think will attract also the younger generation more to our industry, and we need that to be competitive as well. So I think that's what is in there for us as an industry. Thank you.
I think it's great that the financial sector has done its homework, and I think we have to argue a bit more now in the conversation with other ministries and other stakeholders that the financial sector is now ready. And if they would now introduce appropriate regulation or create better visions for the future, better plans, more ambitious targets, that the financial sector, the financial regulation which has been implemented or which will be implemented will massively help to generate the value from such interventions. And I think this is where we now have to talk to stakeholders also outside the financial sector.
I mean, after seeing the conversation about this going on for decades, it is wonderful to see how quickly it's gone up the agenda, and I want to make sure that we grab the opportunity to really embed this in both the industry and the regulation and the policy by making sure that we realise it's a different job to come up with ideas and implement ideas. So that's the first piece. And the other one is, this is really important, and a lot of what E3G does is look at the big levers which might get us to a climate-safe, sustainable world. And after closing down the adequate number of coal power stations in the world, reorientating the finance system, which includes central banks, is the next big lever. So, because there aren't that many levers out there, this is incredibly important to get this right, to enable lots of other people to do what they need to do. So again, it's not just put a heavy weight on you, but you are on the critical path of keeping us in a climate-safe world and avoiding the consequences we don't want to go to. And I think you've got it in your grasp to do it. So that's, that's a great place to be.
So I'd like to pick up something that Nick said earlier, the gap between talking about things and delivery. And I think there is a huge risk that we have that gap also in the financial sector. I think the next years will be defining for that. And following up on the last question, I don't think that this is rocket science. I don't think that's the obstacle. I think the obstacle is political will. I mean, take the example I mentioned earlier on car loans. The ECB should just not buy them. Full stop. It's not difficult. It's just an issue of political will. And if you take climate risk analysis, you got tens of people in this room who've done excellent work on this, and I think would be more than able to support central banks in integrating that into their model and to do the same with commercial banks. And it just needs to be done.
Thanks, Alex. Thanks to everybody. So I will just give my summary of my takeaway from this. So I would say first one is like this whole momentum created a narrative on the role of finance, a sense of purpose, like this idea that there's a kind of definition of how finance can save society. The caveat to that are financial regulation cannot solve everything. And you don't, that's not by managing policy uncertainty that you create clarity on the direction of travel regarding policy objectives. Second takeaway is the critical challenge related to implementation of all these measures. We probably did like 5% of the job defining the recommendation for the H leg, and now basically we still need to land everything, and there will probably be a lot of work to do that and have the answer that are technically right. And as we can see, there's a lot of debate on the relevance of certain tools. And the third takeaway, I would say, is like we can't sit on the fence. So I think this idea that you cannot really ask banks to integrate climate criteria if you don't integrate yourself this aspect as a central banker, this aspect in your own policy. So the good news is that I think there's a few central bankers on the next panel, so they will have the opportunity to respond to these challenges. And in the meantime, I will please ask you to upload the panelists and move to the tea room.